What is refinance? Well, refinancing a mortgage means paying off an existing loan and replacing it with a new one. It's a process that can offer a lot of financial benefits, depending on your situation. There are many reasons why homeowners decide to refinance. Some of the most common ones include the desire to obtain a lower interest rate, to shorten the term of their mortgage, or to convert from an adjustable rate mortgage, known as an ARM, to a fixed rate mortgage, or vice versa. Additionally, homeowners might tap into their home equity to raise funds to deal with a financial emergency, finance a large purchase, or consolidate debt. However, since refinancing can cost between 3% and 6% of a loan's principal and, as with an original mortgage, requires an appraisal, title search, and application fees, it's crucial for a homeowner to determine whether refinancing is a wise financial decision. So, what are the key takeaways? Getting a mortgage with a lower interest rate is one of the best reasons to refinance. If interest rates drop, consider refinancing to shorten the term of your mortgage and pay significantly less in interest payments. Switching to a fixed-rate mortgage or to an adjustable-rate one can make sense depending on the rates and how long you plan to remain in your current home. Tapping equity or consolidating debt are other reasons to refinance. But beware, doing so can sometimes worsen debt problems. How refinancing a mortgage works is quite straightforward. Since refinancing requires a new home loan, the process is similar to applying for a mortgage. You'll need to schedule a home appraisal to determine your property's current value. Your income, debt service ratios, and credit history will all be evaluated, so expect to provide much of the same information that you were asked for when you got your first mortgage. This can include identification, proof of employment and income, details regarding your assets, savings, and debts, along with tax documents. You'll also have to pass another mortgage stress test to determine your ability to repay your refinanced mortgage in the event that interest rates increase. The rate you'll be stress tested at, also known as the minimum qualifying rate, will either be 5.25% or the rate your lender is currently offering plus 2%, whichever is higher. When refinancing, it's important to do some comparison shopping to ensure you're getting the best rate, terms, service, and conditions. Remember, you don't have to refinance your mortgage with your current lender, so it's best to compare several before deciding which one presents the best deal. And if you do stick with your lender for your refinance, don't be afraid to negotiate a better mortgage contract. How much can you borrow? Well, a mortgage refinance is often a way for homeowners to access additional cash. The amount you can borrow using your new mortgage is determined by how much home equity you have. You can typically borrow up to 80% of the appraised value of your home when refinancing, but you'll have to use a portion of what you borrow to pay off any amount remaining on your current mortgage. What's left over can be spent however you like. If your home is worth $500,000, for example, you could borrow up to $400,000 when refinancing. But if your current mortgage balance is $350,000, you would really only have access to the $50,000 left over after paying off your mortgage. What are the pros and cons of refinancing a loan? Let's explore. Pros include: lower rates can reduce your monthly payments and the total amount of interest paid over the term of the loan. A lower payment can improve your monthly cash flow. Refinancing provides an opportunity to increase the amount of funding to add working capital. Improving your debt utilization ratio can help boost your credit score. However, there are cons as well. Applying for a refinance will generate a hard inquiry on your credit report, negatively impacting your credit score. The existing debt may have prepayment penalties. The fees could outweigh savings, making the new loan more expensive than the existing loan. Extending the length of the loan could result in paying more interest. While refinancing loans can help you pay off existing balances faster, it's not always the right choice. Carefully weigh the pros and cons. Do the math to make sure refinancing makes financial sense, and shop around for the best terms and rates. Making informed decisions will support the long-term growth and stability of your business, and in some cases, refinancing can be a key part of your growth strategy.